So what's happening now has happened many times before. And without that kind of perspective, I wouldn't be able to deal with it. And I learned this in my past because, well, just quickly, in 1971, I was clerking on the floor of the New York Stock Exchange. And President Nixon gets on and he says, we're not going to give you the gold that the dollar is backed by. And we had a devaluation. It took me by surprise. I walked on the floor of the stock exchange. I thought it was going to go down a lot. It went up a lot. And that's because I never experienced the currency devaluation. I found the same exact thing when I studied history. Same exact announcement took place on March 5th, 1933 by Roosevelt and had the same effect. So I understood then how history before me was important. Studying the Great Depression allowed me and Bridgewater to anticipate the 2008 financial crisis. If I didn't study that, what's happening now is very relevant, is a guide to the past, is a guide to what's happening now. As we are approaching challenging of the world order, in other words, a great power challenging another, there is an increased likelihood of some kind of war. There are 5 kinds of wars. There's a trade war, a technology war, a geopolitical influence war, a capital war, which we're in the midst of, and then there's a military war. And those things drive countries to be self-sufficient and independent. And as a result, globalization diminishes and nationalism increases. In answer to your question, how does it affect the markets? It affects the value of money, most fundamentally. Like what we're seeing now is that the value of money, when you run very large deficits and you have to spend a lot. You have to spend a lot on social programs. You have to spend a lot on defense. You have to spend a lot on environmental programs and so on. And so when you spend a lot more money than you earn, then you have to print money to make up that difference, to make the purchases. And then that devalues money. And so it's like the examples I gave you of the 2 currency devaluations that you had before. 1971 led to the inflationary period of the 1970s. And so you have the stock market. Yes, the stock market goes up and other things, but cash is trash. And people begin to learn that the bonds that they're holding have negative returns. And it starts to change the value of money, the value of dollars and so on. So money goes into other assets. It produces more of an inflation, and you start to enter a certain type of environment. And the environment that we're in is beginning to be very much like that of the 1970s. There's 2 ways of dealing with debt. You pay it back in hard money or you pay it back in soft money. You pay it back in hard money and you have a problem. You have a depression. So throughout history, whenever that was done, pay it back in hard money. Eventually, that was abandoned and you print money. That was what 71 was. That was what March 1933 was. And so I think that what you have to think about is the value of money. How much money does one have in debt instruments? And do you want to own that as an asset? I think they're bad assets. And then how do you diversify? And the system also has to deal with what is money? What is money? Is the dollar going to remain the same sort of reserve currency? And then you see the development of alternative monies. We're seeing a variety. I think different types of money will compete with each other in the environment we're in. Maybe it's crypto, maybe it's gold, maybe it's other things. Maybe the digital renminbi competes with the US dollar. We're going to come into an environment because everybody thinks that think about how much money is being stored in debt instruments, those debt assets. Think about how poor those returns are. So that kind of a shift, I think, is very important. So all currency have a lot of debt. And so when you look at one relative to the other, there will be a lot of printing. I mean, currency equals debt. And when you hold a currency, you're holding a debt instrument. And so all of those will decline in value relative to other things. Now, will the dollar decline more than other currencies? It's almost certain that we're going to come into this environment. We're in this environment in which there's a shifting of those currencies. So you're going to see more of China's renminbi being used. You're seeing India have a direct link with Russia on the currency. So we're in an important change in the currency. And it also has very big geopolitical implications, because as we come into this environment where we have the second influence, the wealth gap, the political gap, it means that the distinction of how money and the bills are going to be divided and how that will affect tax policy and the like will matter a lot. I think it's very much like the 1930s, which means it doesn't produce immediately a general level of inflation. It negates deflationary pressures. And what it does is it produces currency depreciations over a period of time. In the 1930s, all currencies in the early 30s depreciated in relationship at that time in relationship to gold. And so what we see is the same kind of thing happening without a general level of inflation, but not just gold. It goes into other storeholds of wealth and stock, particularly certain types of stocks, but very much the same as 1933. In 1933, March of 1933, Franklin Roosevelt severed the connection with gold, printed money, and made money available. And that was the exact bottom in the stock market. Very simple, similar to April 9th when Federal Reserve and the Treasury did the same thing. So that goes into other assets such as stocks and so on, and creates a reflation. It is necessary to be done because the consequences of not doing it are unacceptable. The wealth gap and so on. We're in a situation where every individual, every company, every government has a certain amount of revenue, a certain amount of expenses, and a certain balance sheet. And when the revenue goes down to be low or inadequate relative to the expenses, and there's not an adequate balance sheet, then defaults and restructurings take place. What has been true in history is that when you have an economic downturn, that's a serious economic downturn, and less effective monetary policies at that same time, and you have a large wealth and values gap and political gaps, you tend to have fighting, internal conflict. And so rising internal conflict about how to divide the wealth pie is very, very normal historically. And so that's the dynamic, I think, that we're now seeing that will become manifest in changes in tax policy and so on. The investment environment going forward will be very different from the environment of the past. I mean, think about it as a zero and low, very low returning asset environment, because the liquidity that's in the market is driving the excess returns of all markets down to be low in relationship to the very low cash rate. So negative real returns, not good for cash and so on. The most important thing is to know how to diversify well. And what I mean by that is to go beyond just the traditional 60-40 stock bond mix or even the same countries, and to broaden that diversification. To include in that portfolio assets that might seem unusual, to include some gold, to include inflation index bonds, to think about the currency exposure, to think about safety as different. Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it, but it has, because they're producing so much cash, it has a negative real return. It's a tax that maybe 2% a year you lose money in terms of cash. So you have to think about risk differently, and you have to diversify best. That's the most important thing, to have a well-diversified portfolio. The uncertainties that we have today are so great in terms of all the things I mentioned, the tax policies, the geopolitical. Diversification can be achieved without reducing your expected returns because of the way that asset classes are priced. And then if you're going to take tactical bets from those, then those tactical bets, alpha on top of that strategic, well-diversified portfolio, should have highly diversified bets deviated. Liquidity is going to be more important than before because things change in unexpected ways. Look at how, in many of the cases, the businesses that one would have thought was a good business. And let's say you're in private equity and you're with that company. And so the restructuring, the ability to rebalance and diversify and to be cautious about making a highly diversified set of bets is, I think, the future. But thinking even of asset classes, thinking about the value of money. We look at asset classes and we say, oh, do I want my money to be in stocks and which stocks? But we don't think about stocks, bonds. We think about those traditional asset classes, but we don't think about the value of money and what's going to happen in terms of the printing of that value of the money and how to diversify it well. So I think those are the things that have to be paid attention to, in much as they were important things in years prior to 1945. But the interesting thing about that is when you look about when interest rates, let's say bonds, approach a zero expected return, clearly their ability to go up in value or interest rates to go down in value is limited, or in order to have the impact, one has to leverage those a lot, and that's not desirable. But clearly through history, and I studied the last 500 years of cycles, going back to the Dutch cycle in terms of the Bank of Amsterdam and that whole cycle. In all cases, central banks will print money and devalue money when they get in that course. The basic problem of a depression is basically a debt liquidity problem. All currencies have devalued or died over a period of time, particularly in such periods. We're in a new paradigm.